There are, of course, plenty of dividend stocks out there, but that doesn't necessarily mean that all of them are good opportunities to buy. Most of them are not. So today I've compiled a list of 3 separate dividend stocks that I think should be on your radar if you're looking for a dividend stock. All of these are, of course, different. They're in different fields. So some are energy, some are tech, and just to give you a variety. So it's not just here's 3 utility companies, right? And there's nothing wrong with that, but you guys want variety. And the first one we're looking at is Energy Transfer. And sometimes names suck, but this one is pretty accurate. They do energy transferring. So they assist in the transportation, natural gas, oil, things like that. They're based in the United States as well, so there's no worry about sometimes you got to get worried about oil companies. Okay, are they foreign? Because believe it or not, there's a lot of foreign oil and that sort of stuff. They are American. They have done well as well. Over the last 5 years, they're up 50%, so they're outpacing inflation fairly dramatically. That's important for dividend stocks because that can really hamper some of the yields and some of the performances if you're not careful. Even though this is one of the most inflationary periods in the U.S. history, of course, depending on where you're at, but generally inflation is about 22 to 25%. So you are beating inflation, you're beating it fairly dramatically in terms of share price. But in terms of forward dividend, you're getting about a 6%. Now, I'm not claiming they are perfectly 6% or just at this rate throughout this entire time period. I'm not claiming that. However, they're a high yield. This is a high yield. Anything above 5%, in my personal opinion, is in that high yield category outside of the normal dividend stock. So this one, like I said, you're getting that good yield. And if you zoom out, it's not like this is a stock that's not performed well over a long period of time as well. Even if we go from highs in 2007, you're at about 10 a share. Now you're at 20, and then you get that dividend the entire way. Also, unless you bought at highs in 2015, when it was at 32, and I'm assuming the dividend was higher there, or there was things just booming in business. Obviously, there's a crash thereafter. But unless you bought at the tippity top here, or somewhere really high on the way up, you're probably happy with this performance long term. There's not a lot of crazy highs. Even here, you're up. And then, like I said, you get that dividend throughout. So, in my opinion, you're happy with this dividend, and then anything on top in terms of share price is good. Maybe it beats inflation long term. Maybe it doesn't. Of course, we don't know. But historically, this is a company that has outpaced inflation. And like I said, that yield is pretty good as well. The next one we're looking at is Realty Income. And yes, I have covered the stock. If you're one of those that watches my channel, I've covered this one before in these types of videos because I think it's really good. I also really like, not Dukes, I was going to say Dukes, Vici at this price. So obviously we were hitting quote unquote highs. Obviously you have higher highs here with this specific stock, but you were hitting highs. People were getting kind of excited about rates, falling. So the stock price goes up because that's generally better for these businesses. However, I like with this sort of stock, dividends, if you aren't someone who's investing in dividends to retire, and if you are, it's still not a bad opportunity to buy. However, if you're doing it for diversification, primarily that's what I'm doing. I'm not super close to retirement age. You can probably tell that from my voice. So what I like to use it is as a hedge, right? Hedge against recession, hedge against inflation, hedge against growth stocks tanking if there's something like that. I'm not expecting that, but if it does happen, I don't want 100% of my eggs in one basket, which is tech. And tech, don't get me wrong, has been phenomenal, but we don't all want all our eggs in one basket. So when it's low in this range, this is when I want to be buying and holding, because if it just runs sideways and it doesn't go up or it goes down, you buy more and you get this awesome dividend yield of 6%. There's really not much to complain about here. Of course, unless the company does crazy terribly, which is possible. That's why we diversified. This isn't the only dividend stock I'm interested in or own. Vici is another one. I own utility stocks as well. As long as you're fairly diversified, you're fine with this. If you buy at the lows and just hold through, and then you sell a little bit when it goes higher. I did that especially with Vici. And Vici, this isn't just for O. I think O, Vici, probably some of the other REITs as well are really good opportunities right now. If you don't mind parking your money in a dividend, riding it sideways, and then selling a little bit when it goes up. I'm not a big trader. It's not what I do. That's not really how I'm looking at it. I'm hedging money certain ways. So I'm not a hedge fund, but there's something to do. So I think anything honestly below 55, certainly below 50, I'm really interested in this stock. Same with Vici. Anything below 29, 30, I think that's a really good opportunity to buy if you don't mind holding it long term. And then anything like above 31, 32, at least in the short term, is not bad to sell that little extra you put in it. But REITs, I think, are going to do fine. Like I said, if you don't have a short time horizon, there's absolutely nothing wrong with zigging when the market zags. It's not like these companies are going to go bankrupt when the rates go up a little bit, even though the market perception is bad on them. And some may, I doubt it, but if they do, it's not like they were probably well run anyways. Texas Instruments. I have not covered this stock on my channel. And part of the issue is just how it's oriented. Same thing with McDonald's. It's hard to put it in lists like this because it's a stock that really doesn't fall into one specific list. I think I'm going to put it into the dividend category. Although if you want kind of, it's not cheap though. Okay, so I'll lay it out for you guys. You guys aren't dumb, I know that, but you might not be understanding what I'm saying. And oftentimes, at least as investors, it's easy to group stocks. So this is a dividend stock. This is a growth stock, right? This is a value stock. Value stock, okay, it's growing decently well, or it's cheap and it gets a little dividend, but the PE is low. So Texas Instruments, the PE is not low. And then growth stock, you would want growth hopefully near the S&P 500. With this, you kind of don't. You're at 47 S&P 500, some are at 80. So you're above PE there, and then your growth isn't as much over the last 5 years. And then your dividend, it's not quite where you'd want it for a dividend portfolio. We'd probably want something at least 3 or 3.5. However, I think it can fall into either growth or dividend. I think in a dividend portfolio, this is going to be one of your lower yielders. Over the long term, hopefully it should outpace inflation fairly dramatically. If we go back to 2015, which 10-year time frame, that sounds like forever, but we're really not talking too crazy amount. It was at about 60. So you have performed roughly, well, if you include dividends, you've outperformed. If you reinvested dividends, you've outperformed the S&P 500, which is up about 200%. Clearly 58 to 192, you're outperforming there when you're reinvesting dividends. So I think I like it though. If you're just holding the dividends and you have a well-diversified portfolio of dividend-centric stocks, I think it's a good opportunity. I think I'm talking more about the stock specifically. How about I dive a little bit into what the company actually does? Texas Instruments provides semiconductors. Wow, you've never heard of that on this channel. I cover semiconductors a lot. They aren't the traditional semiconductor company where they just do the high-tech stuff. Not that they don't have good technology, but they're more of the embedded stuff. And when you think of embedded semiconductors, that's primarily computers you have that are less sophisticated, stuff like in microwaves, right? There's a computer in there. It's not like doing your taxes, right? It's not, but it's still doing its job, and you have those in all of them, and they're going to need more and more sophisticated ones as well. It's not a bad industry at all. Clearly they've done well. They're a good company, but they just maybe don't have that crazy upside, so they aren't valued necessarily like a growth stock. But however, I think if this was in a dividend portfolio, you still get that nearly 3% 3% yield, which isn't terrible. It's not quite where we'd want it to, even a dividend portfolio aiming for a 3.5 or 4% yield, but I think it's going to carry the share price performance of it, meaning over a long term, it's going to outperform inflation, and then that'll kind of balance out some of the stocks you have that maybe aren't. So I like Texas Instruments. I like it as a dividend stock and maybe as a growth stock, reinvesting dividends. I don't necessarily like it as a value stock because I think it violates the first principle of a value stock, which means you're cheaper than average, which technically they aren't. I mean, let's take a look at Ford PE real quick. 30, yeah, you're clearly not. You just aren't. So unless GAAP is completely wrong, which could be the case, but I haven't heard that. So anyways, that's basically all I got. Hopefully you enjoyed me covering these 3 specific stocks. If you learned something, I appreciate if you like or subscribe. I do daily stock content on this channel. I appreciate all of you for watching, so I'll catch you next time.